Joining us right now to talk about that and much more is Dan Tarullo. He is former Fed governor and current professor of Harvard Law School. Dan, you hear that word transitory, and let's just call it what it is. It's temporary. Is this going to be temporary, or is this for keeps? What do you think about the inflation picture right now?
Well, Becky, I'll be straightforward. I don't know. And I think that's actually the problem that the Fed has and has had for some time. There really is not a workable theory of inflation that helps them to make decisions on a meeting-by-meeting basis. You know, output gap, Phillips curve kind of analysis hasn't worked for a couple of decades now. The Fed relies heavily on inflation expectations being well anchored, but nobody really has a good understanding of how those expectations, why those expectations change when they do. So I think they're sailing in the sort of cliched uncharted waters. And I think that presents both a substantive policymaking problem, but also a big communication problem for them.
Yeah, when you're sailing in uncharted waters, though, isn't the thing you would normally do to slow down a little bit, pull off on the steam so that you can kind of find your way, maybe tread a little more carefully and cautiously as you go? I think that's why the feeling on Wall Street, at least, seems to be that, hey, they're going to have to do something sooner rather than later. And we're not talking about raising rates, but just stop the incredible extreme measures that we were taking during the height of the pandemic.
Right. And I think if this were 2 or 3 years ago, I think that's probably what you'd be seeing right now. But there's another consideration here, which is, as you recall, just last August, they put into place a new guiding framework for monetary policy. And that framework indicated that they expected and wanted inflation to run above 2% for some time, which Jay Powell characterized as a form of inflexible inflation targeting. But we don't know how long. We don't know over what period they want it to average so. We also know that they changed their understanding of the maximum employment part of the dual mandate. But there again, we don't have, and they haven't had a chance to give us much more sense of exactly what they mean. So I think that part of the communication problem here is if they were to materially pull back or suggest a pulling back, that seems inconsistent with the monetary policy framework. At the same time as you said, both markets and former Fed officials and some academics have been suggesting that we've turned a corner on that period of low for long inflation.
Yeah, I mean, if you listen to the people who know it because of the numbers they see every day, like Brian Moynihan with Bank of America's numbers, like American Express's CEO, who was on with Cramer last night on Mad Money, I mean, they are seeing real-time consumer activity, real-time business activity, and they're seeing it pick up at an incredible pace. What numbers, what data is the Fed watching on this?
Well, I think this gets back to the transitory issue, right, Becky?
Yeah.
I mean, so on the demand side, you can be, I think they're probably going to be looking at the degree to which those stimulus checks that have been saved by consumers are going to get spent down and the kind of things on which they're going to get spent. They'll obviously be paying attention to the size of forthcoming fiscal packages on infrastructure and the education, childcare, that package as well, and the degree to which those are or not paid for with taxes. On the supply side, the big issue is going to be is the labor market, of course, and there I think they'll probably be looking at labor force participation again. Will that apparent spate of early retirements be reversed and bring people back into the labor force even when they've appeared to retire? And of course, something that I know you've reported on, which is the chip shortage issue, yeah. and shortages generally and sort of supply bottlenecks.
And the shortages, by the way, you can label them temporary or not. We know that the chip shortage, for instance, is not going to be fixed anytime this year. This is going to stretch into next year. And I guess that gets into this whole idea of when is it temporary and when is it, oh, my gosh, month after month after month after month after month.
Right. And of course, there's not a month cutoff. What's important for inflation purposes is whether, as a result of one set of price increases, other actors in the economy begin to raise prices as well. And there becomes a dynamic. And again, I don't think coming out of this very unusual period on the heels of over a decade or 2 decades almost of sub-target inflation over that period of time, I think it's just very difficult for people to make an evaluation of it, which is why I think you see a lot of different assessments and why the 10-year, for example, has been a bit of a puzzle in recent months.
Shepard Smith here. Thanks for watching CNBC on YouTube.